Hey folks, Tom Norfleet with www.citizenshipquickly.com. Want to tell you some things today that'll put you ahead of the game. Some of the videos I've put out too have specified this more in detail. But when you're putting your hard-earned money and you're investing it somewhere, some things that I can tell you right off the bat that will pretty much safeguard. You're always got a chance of losing money if you go in equities or anything that's like a mutual fund, anything like this. But I'll tell you some things that will put you, it was more or less, it will help cushion some of the things. And first of all is dollar cost averaging, which I've gone through some of the other videos, and that's putting an equal amount of money in every single month. That way, if the market's dropping, you're buying more shares if you're putting the same amount of money in every month. The other is actually going and picking brokers that actually charge no fees. You know, a lot of people just don't, maybe you've heard about this, but they just don't do it. Let me give you an example. Fidelity just came out with a S&P 500 index fund where they're undercutting Vanguard's rates. They want to charge zero. Now, you know, I put in another video on there how they're able to make money. You know, one way is by taking your money, and hopefully you'll go in other funds they've got that have fees. Have management fees, even on no-load funds that charge management fees. Or, you know, they'll take the money and reinvest it. Maybe you've got in cash somewhere else. They're finding ways to make money, but these are things you really should take advantage of, is not just index funds that have no fees at all. And I'm talking about truly, that's what I call truly a no-load fund, is when you have absolutely no management fees at all. That's what I call a true no-load fund, okay? Not one that has management fees. The other way too is go with it. There are companies now that you can buy U.S. equities, not foreign equities. I had mentioned to you that Charles Schwab just bought Ameritrade out. Ameritrade now, to compete, they're letting people buy equities at you know, at no commissions as long as they're U.S. equities. That's a huge added incentive. Now that doesn't mean that they don't have no-load funds that won't have fees. That's where they make money too. And also Fidelity has the same thing too, is they all have funds that still have, they call no-load funds, but they do have fees involved with them, and they're hoping that some way, somehow, you'll be jumping to some of these other ones. But, you know, you think about it, the indexes, and not just the S&P 500, the Hang Seng has outperformed a lot of cases most fund managers that invest in Hong Kong stocks. So, you know, these are no-brainers that you can go into and save money right off the bat that, you know, you really should be taking advantage of. There are other things too that you can look at, like on my other videos I've talked about withholding tax. Or, you know, you can go in and pick equities that are in countries that have no withholding tax on the dividends. Now, like I said, if you're a U.S. citizen, I've mentioned this in prior tapes, you're a tax resident in high tax countries like Germany, France, any country that taxes worldwide income. If you're buying these equities, even if you're buying them outside the country that you're living in, if you're a U.S. citizen still, you're in a high tax country or low tax, it doesn't make any difference. If they tax worldwide income, you're still reported by law in that country to report that. If they do tell you to tax, that country taxes dividends, even if there's no withholding tax. So if you want to get around that, go on our website and we can show you how to do that, okay? That's part of what we do, is show people how to get around all taxes. We can help you get your taxes down to zero. But if you're going to do it legally. And you need to take some moves to do it. I would advise you not just to do it and then not look at the ramifications, because you're going to get in trouble with the tax authorities. You need to look at the website, go through the details. It's a little bit of trouble, but you can stop your tax if you do it. But there are 21 countries in the world that have no withholding tax. So, you know, I'm telling you ways, and that's a guaranteed savings of around 40% of your profits. Dividends typically make up around 40 to 50% of your profits. So by knocking back that's guaranteed. When you're going and buying, if there's no withholding tax, you already know off the bat, you're already ahead of the game on taxes. And these are guarantees that I'm telling you right up front that add to your money. is not just brokerage fees, but get around the withholding tax. Man, when you got a lot of money, and our average client's got around $2 million or above, I'm going to tell you something. When you got a lot of your money involved with these type of investments, you're going to be losing literally tens of thousands, maybe hundreds of thousands of dollars a year by not just slowing down and looking at what you're doing. I mean, this is real important that you take the time out to look at what you're doing and examine it, and then go from there. One thing I'll tell you too, that's a lot of people say if you ask them when is the best time to buy, when the market's low or high, they'll always tell you when it's low, but that's not what they do. They'll always jump in when everything's positive. The news media is expelling how nice the market is, and somehow they're jumping in near the top or at the top. It's very hard to go into areas that have been really, really beat up. I tell you a guy you really should listen to that's really good on contrarian type investing is Jimmy Rogers. He lives in Singapore. This guy's got enormous knowledge, very humble guy. You can go on YouTube, pull him up, listen to some of his facts. He used to run the Quantum Fund with George Soros. They had a phenomenal track record. They killed the S&P 500 index while he was there. No comparison. They left it in the dust. So this is a guy you should be listening to and getting some good facts on contrarian investing. But I'll tell you a double whammy that really can get you ahead of the game is go in equities or funds or into ETFs where the currencies that have been beat up and the equities have been beat up, and you dollar cost in those areas. And then what you do is you pick those areas where the news media has just blasted. And now I can't tell you where the bottom is. That's why you dollar cost. Okay, I'll tell you some areas been really beat up right now that people can invest in. Venezuela right now is almost impossible to go in that market. Jimmy Rogers right now says that he loves that market. Okay, he loves places like North Korea. Okay, now most people would say, who in the hell in their right mind would want to go in these two places? Well, let's look at the Venezuela market. It's down about 94% for 2018. How bad do you want to go than that? That was worse than the Great Depression did. I mean, we're talking about in 1 year, this is what it did. Argentina's market just plummeted just recently. And these are markets where not only have the equities been beat up, the currencies have been just bashed. Now, if you go in something like this, you're better off going and picking an ETF and going and dollar cost average, and don't start sinking in money at one time. And I'm going to tell you something, these are very high risk. You can lose all your money, okay? But the potential to make a lot of money is very high because you're buying either near or at the bottom at these levels when it drops 90-95%. But this is where you've got to have a thick skin, and you got a dollar cost average when you do this. You put the same amount of money in every single month. But this is the key. Stay out of areas where currencies, and you need to do some homework on this. And don't listen to me. You need to get with a financial advisor to give you some advice on this. I'm giving you some details, and then you take it and work from there. We don't recommend securities to people, and you need to do your own homework or get with someone that can help you there. A couple of things I want to tell you too is there are currencies that you want to stay away from. There's some that have been beat up, and I mean beat up. You don't want to go in them because these are currencies that have been constantly going down for 40, 50, 60 years. I'll give you two examples. The Dominican peso is one of them. Another one is the Philippine peso. Okay, you can literally go back maybe 40 or 50, 60 years, and you can see, you'd have to look at the currency. You can pull up the charts where at one time both of these currencies weren't in pair with the U.S. dollar, and that means one Dominican peso was worth about $1 US. And the same way with the other currency that I just gave you, the Dominican peso and also the Philippine peso. Both of those were in par. The Philippine peso was worth right around $1 US. Now, go back now, years later, now it's about 50 to 1, about that. Okay, you'd have to look, but it's approximately 50 to 1. The US dollar can now buy approximately 50 Dominican pesos, and the 1 US dollar now can buy about 50 to 51 Philippine pesos. Now, these are currencies that have dropped constantly. Okay, we're not looking about a currency that's fallen out of favor, like maybe the Russian ruble, or the euro, the currencies like the pound sterling. The pound sterling, was roughly right around 210 to 1 pound sterling could get around 210, or approximately that, to the US dollar. In other words, 1 pound sterling could get around $2.10 of US dollars. And you'll see that currency more than likely come back and might even exceed 210. No guarantee to it, but it could. Okay, these are currencies that float in and out. Okay, when you go in these exotic currencies, like I'm just telling you there, this is the problem you have to worry about. If the equities are beat up, you could go in the equities at bargain prices, but the currencies could continue to fall, which erodes your equity appreciation. So you have to look at that. And if you don't know that much about that, you're not willing to check it out, then probably you're better off staying in the currency of your own country, wherever that is. If you're from Germany, I would stay in the euro, okay, and don't get out unless you know what you're doing. But this is how you get a double whammy. You get a growth on the currency and on the equity, because let me give you an example right now. Right now, Russia is a good example. Russia's equities are around 3 to 6 times earnings. You can buy equities there incredibly cheap, okay, and the currency has dropped way out. It used to be you could, not too long ago, you could get 1 US dollar would buy 25 rubles. Now it's, I hadn't checked it today, but it went in as high as almost 80 rubles that you could get for 1 US dollar. Now I think it's right around the 50s or 60s. I haven't checked it today, but not too long ago it was 25. So you can see how weak that currency is against the US dollar. Now, a lot of it is because the dollar's been real strong. Okay, and we've been through this period, and we're going to be getting out of this period. Once we're out of it, you could see a stagnation period like the S&P 500 did from 2000 to 2010, and where the market doesn't do much, and that's usually a weak period in the currency too. And if you're out of that currency, like out of the US dollar, when that ruble or whatever that currency is, and that currency typically does good when the dollar starts to plummet, and those equities come back and the currency comes back also. No guarantee, but this is typically what you'll see. But you need to go in currencies that you've seen a track record of coming back. These currencies that have constantly dropped for 40, 50, 60, 70 years, I wouldn't buy equities there. I wouldn't buy currencies there, okay? I would stay out of those markets. And a market that I'm talking about is Philippine market, and also the Dominican Republic. And there's tons of other areas too where you can see these equities do real well, but the currencies just continuously go down, which just erodes your equities, because now you buy a lot less with the dollar. So you really have to look at this and examine what you're doing. But this is the type of deals that Jimmy Rogers did when he was getting phenomenal track records. He was doing his research and looking at areas that were really beat up. This is how you make money. You don't make it when it's popular. Like right now, the U.S. market is through the roof. It's very high right now. The dollar's pretty high. The actual equities have done extremely well. That's not a time to be jumping in. In my opinion, for what I would be doing is going in areas that are beat up, and then dollar cost average. Don't try to pick the bottom out, okay? Even the best can't pick the bottom. You take the same amount of money in and you spread it out. I would do it at least, if you've got a lump sum, spread it out at least over a 2 to 3 year period at equal amounts that you're putting in. Because more than likely you'll get through that bottom part and then back on its way back up. No guarantee it could continue to drop, okay? But that's why I say if you go in ETFs, you're going in a group of equities in that ETF that it's tracking, and you're tracking those equities that make up that particular country. And this way it's a lot safer too, because if one of those companies go under or 5 go under, typically what happens, they replace it with another equity in place. So your investment's minimized somewhat by doing that versus picking an equity itself, especially going in these areas that have been really, really beat up like Argentina. Venezuela, the only way you can go in Venezuela right now is picking companies that have actually gone in and done joint ventures with Venezuela, and there are companies like I think I saw Rosneft had done some business there. I think Gazprom had done some business there. But do your background on this. You need to check that out yourself. But these are areas that, to go in Venezuela directly, and some countries too have sanctions against the country. You can't even go in it, to my knowledge, if you're a U.S. citizen now. So, but if you're a citizen of another country, check out the laws in that country to see if you can go in there. Because if you can't go in there and the laws tell you not to do it, then don't do it. Wait till those sanctions change. That's what I would be doing, or either get out of that citizenship or your residency, however the law is worded, to where you can actually invest there. So many people lose opportunities because their country tells them they can't go somewhere to invest. If you don't like those laws, then become a non-resident. If you have to give up your citizenship, get out of the citizenship, okay? It just depends on what you want to do there. Anyway, and folks, also, if you got a tax problem, go on our website, look at our website, and you can get some great details on how to get your taxes zero or close to zero. If you don't do it with our company, get with somebody, that knows how to do it and do it right and legally. And why go another 10, 15 years and then look back and then find out that you could have done this and you didn't do it and you lost a fortune in taxes? If you got a question or comment, put it below. We'll see what we can do to answer any questions you got. And also, if you hit the subscribe button to the right of the screen, you'll get all new videos as they come out. And every one of our videos that come out, we try to show you something to save you a bunch of money. I mean, we don't try to waste your time. These are things that have saved me a bunch over a period of years. We have all different types of things that we can go over with you. Anyway, take care and look forward to talking to you on the next video. Take care. Bye.